Okay, good afternoon and welcome to this very special edition of Winston Capital with Latin Advisors. So as you know, David and I have been traveling around Argentina and Uruguay, have some meetings with people. We have a little bit of a mishap, one of the lunches, we did a breakfast, and we had like about 45 minutes to an hour meeting with different clients and very entertaining. Many of you remember when David and I used to travel around Latin America, Israel, having a lot of fun. So, David, the question for you is, let's try to summarize a little bit, 10, 15 minutes, whatever you want, your thoughts from these two lunches that we had, and then we had an afternoon presentation today at this Latin Securities amazing conference, over 1,000 people here at the Enjoy Hotel in Punta del Este. So, David, all ears.
Fabian, it's just wonderful to be here with you and to feel the energy here at the Latin Securities Conference here in Punta del Este. I think the couple of themes that we tried to stress in visiting with your clients and investors, the world has changed, that we are basically entering a new phase, a new era. Inflation and interest rates are probably not going to be what they were for the past 10 years or so. Easy money days perhaps are over, so that's one of the themes. Secondly, debt and demographics. These are macro influences on investing and on investor psychology that I think are going to persist. Technology has come much more into our awareness, Fabian. Talking about artificial intelligence, talking about gene editing, talking about ChatGPT, so the ability to have spoken response to search inquiries, and what is that going to do to the business model of Google, for one, and what is Microsoft doing with its big investment in AI company. The globalization theme of the last 10, 15 years, with great power conflict going on, this, I think, is putting the globalization idea in some calling it into question. So that was the first part. Secondly is the recent banking developments. We had in the United States, of course, Signature Bank. You had Silvergate, which was very heavily crypto exposed, and of course Silicon Valley Bank Corp, and more recently First Republic Corporation. Let me just say, these were four poors: poor supervision, poor management, poor business model, and I would say poor reaction. We had a lot of confusion by the Treasury Secretary, by the head of the FDIC, by the Treasury. They were giving conflicting signals and conflicting guidance as to the amount of deposit guarantee. That having been said,
Heads will roll?
Pardon?
Heads will roll?
Well, people have been calling for heads to roll, but we will wait to see that. Okay. But a lot of flip-flopping, Fabian. What's amazed to me has been the reaction of gold, crypto. Crypto's up 70% this year, and it's been very strong.
Amazing.
I'm not a fan of crypto, as you know.
We're not in Winston either.
Yeah. But gold is up strongly this year, 8-9%. And the big five, this is Microsoft, Apple, Amazon, Google, and of course Meta. Yep. These big five have had a big move, especially during this crisis. So they were, in a way, the new form of Treasury securities, people fleeing into this group of stocks.
But some people argue the fear of what happened in banking, and we are Credit Suisse to that equation, brought rates down. And this is what killed techno last year. Rates up because of valuation.
Long duration.
Long duration assets, discounting big earnings at a big multiple. So I think the rally was a little bit, helped by this. We had a big rally in bonds, rates going down, right?
Well, you've had an unwinding of the quantitative tightening that was going on. The Fed
Right.
had begun to reduce its humongous balance sheet from 8.8 trillion. I think it got down to close to 8 trillion. Now it's back up 300 or 400 billion. So they've begun to unwind about 2/3. They've unwound 2/3 of the unwinding. Okay.
Oh, okay.
So I think another thing that people have missed, who's going to pay for this? The cost of this bailout so far, and it'll be higher than this, is $28 billion. Who's going to pay for this? This will be an assessment on the big banks. So
Yeah.
JP Morgan, Citigroup, Wells Fargo, Bank of America, and banks in this category are going to be paying a much larger special assessment. The size of the FDIC insurance fund is 126 billion.
Which is shocked me as being very low.
It's very low. The
I mean,
total
for trillions,
amount, 17 trillion is the amount of deposits
Deposits
in the United States.
It's nothing. I mean, just right.
The final point on this recent banking development.
It should be at least 5-10% of the total deposits, because you charge every year. It's like an insurance business. Yeah, you accumulate, right. I was shocked that the number is only 125 million.
You said this the other day several times, that people don't like to pay insurance.
Right.
And in this insurance fund, the backups is way too low. It's far too low. Now, the last thing I would want to leave a point with you on this is the entire point of these regulatory changes, Dodd-Frank and the other things that came in the wake of the 2008-2009 great financial crisis, was that when we got to another crisis, we would not have to call Jamie Dimon to bail us out. And guess what? This time we had to call Jamie Dimon once again. So we've come back to square one. The next topic that we visited with is the Federal Open Market Committee action that was taken on March the 22nd after their March meeting, the two-day meeting. First, they raised interest rates by 25 basis points to 4.75 to 5%. With a very short message. It's usually a larger message that they put out, but this indicates some degree of Fed uncertainty, maybe even Fed anxiety at the time of the meeting. Again, we're several days after that now. Here we are on the 29th or the 30th, and we've basically come to a full 7 days since last Wednesday, so things have calmed down considerably since then. So maybe that statement would be longer if they were writing it today. The second part is Chair Powell also emphasized this in his verbal remarks, which is you can expect this to lead to bank credit tightening. Especially among the mid-sized and lower-sized banks. They're going to tighten credit, also big banks, and that's going to put downward pressure on the economy. He used this word. He's been focused on labor costs, as you know, service costs in particular, and those have not yet shown. We have not seen in the high-frequency data, which you look at data constantly, and you're a huge reader. Unemployment claims, the new filings for claims have basically been week after week below 200,000. You want to see them begin to scale up to 300,000, showing weakness, which means that people will be having less claim for higher wages, okay? And that will begin to bring down the services part of the inflation, which is Chair Powell and the Fed's focus. The Fed funds rate right now, as of today, is giving a 37% chance of a 25 basis point increase on May the 3rd and a 63% chance of a zero increase. We will see. I think you're going to have April 7th, which is Good Friday, okay? The 2 days before Easter, you will have a next employment report, jobs report, and the numbers are expected to be 240,000. That's for the month of March.
That's next week.
That's next week.
But it looks like we are
240.
using soccer terms. we are in the last 10 minutes of this game.
Last 10 minutes, yes.
Of the Fed tightening. Might be extension, but we might have an extension.
We're much closer to the end of the tightening than the beginning.
Right.
You've said this.
All right.
February was 311,000 jobs,
Right.
and January was 508,000 jobs. So you're seeing, I think, still growth, but slower rate of growth. You're going to, I think, my view is we're going to expect a recession to unfold as we go through this year. The first quarter is coming in. You would not believe this. The Atlanta Fed gives you quarterly.
Which, by the way, we follow in Winston very thoroughly.
I'm glad.
We reported the Atlanta.
GDP now.
The GDP now. We use GDP now. Our clients are very familiar to the GDP now because it's been very good, actually.
3.2% right now.
That's what
they
we've been
have
saying.
A revision.
Exactly.
They will have a revision tomorrow, so you'll get another on the 31st of March. You will get another update of this. But look, it's above 3% for the first quarter. So the next 3 quarters are expected to be somewhat of a downward stepping movement, Fabian, where you're going to end up this year with an overall growth. This is the consensus of Bloomberg, 42 economists, only 1% this year, next year 0.7%. So why? You have the lead economic indicators have been down for 13 months in a row. You have housing slowing down, which is a big part of the economy. It's up to 40% of the inflation numbers, and it's a very important part of the economy. You have the tightening effects, the lagged effects of the tightening. You have the inverted yield curve, and you have the ISM manufacturing. The services have been above 50, meaning expansion. The manufacturing has been below 50. Yeah. So this is why. So here we come now to the last part of visiting with your clients and colleagues. Portfolio positioning. We think the next 15 to 20 months.
That's the key, because of all that is like.
Where does it chop?
Where do we put the money, according to David?
S&P 500 closed at 40.27 last night. I find that amazing. It's exactly 13% above the low, which was October 12th, 35.77. It's 13% above it, and it's 13% below the last 12 months high, which was January the 3rd of last year, 46.02. So it's right in the middle, 13% above, 13% below.
Crossing the river, we're right in the middle.
We are right in the middle.
We see the other side, but we're not there yet.
We have this inverted yield curve. 4.08% is the 2-year Treasury yield, and 3.57 is the 10-year yield. So it's a negative 51 basis points. It's been as low as negative 100, as you know.
Yep.
It's when it rises, when it begins to come back up towards the positive level, that is often a precursor. Now the storm clouds of the recession are getting closer. We are counseling CCC, caution, cash, and conservatism. There's nothing wrong with collecting 4.5% on short-term money right now while you slowly assess. And then part of this is this value, growth, and defensive allocation within the equity part. You can have some bonds, not a lot of bonds right now, but we think value would be 30%. Growth would be 35%, and defensive 35%. So value is a little bit less. The banks, by the way, the KBE Bank Index.
Yeah,
so far this year,
regionals. Yeah.
This is the KBE, which is the banks, and then the KRE is the regionals, as you know.
Right.
The KBE is only down 6% this year. So the big banks, the 24 largest banks, have held their value. They sold off. They've come back. The KRE is down 24% year to date, and 25% of the 24% is the month of March. So all the damage has been done now. But we don't think it's time. This is in the value segment. You've got value is it's banks, it's financials, and it's of course energy. Okay, that's the classic value components. Energy, you could nibble at energy. Oil price is down. You could nibble at some energy right now and collect some yields. Fine, 3.5, 3.8, 4% on some of these great energy companies. The growth is going to be your technology companies. It's going to be some of the communication services companies. They've moved these things around. They've taken Visa and MasterCard out of financials and put them into tech. You see this recently.
Right.
So there's been some movement there, but I think you could nibble, and this one's probably the area that probably would be, when we get to the last stage of this Shakespearean drama, five acts. We're in Act 4, I think, of the correction, and it's not done yet. But we think we're in the last act of this correction, and that will be one that takes some bullets. Okay, the tech. So you want to be very slow in the growth section. Then the defensive section, which is expensive. We've talked about this repeatedly the last 2 or 3 days. This is healthcare. This is utilities, okay? And it's consumer staples. Coca-Cola, Pepsi, Clorox, okay? Procter & Gamble. These stocks are solid companies, but they're selling in the 25 to 30 range, with the market selling about 17.5 times earnings. So you want to be very, very careful and judicious there. Let me just conclude. Anybody who's watching this today, who's a parent, would relate to this story. I took Charlie Munger's famous speech from the University of Southern California Business School. He gave this in 1994.
Famous, very famous.
Two more years will be 30 years ago. It's a 40-page speech, Fabian. I gave it to my daughter, and you know her very well, and she's a very accomplished, smart woman. 2 or 3 days, a week later, we're having dinner. She starts talking about the paper, and it becomes apparent to her that her father, who gave her the paper, has not read the paper. So,
thank you for the example.
I had to go and summarize the paper. I was so guilty. I summarized the paper, and I summarized the 40 pages down to 2 pages, which I'm happy to share with you, by the way, and your friends and clients. In there, the key point that Charlie Munger makes is, over the long term, and this is a key phrase, long term. He and Buffett are long-term investors. Compounding, get good companies, research them like crazy, and then get good companies. I'm going to quote George Soros as well. George Soros says, it's not whether you're right or wrong, it's what you do in consequence of being right. So when you're right, Munger, Buffett, you've got to load up the boat. But you can't be right if you don't do research, or you don't rely on people like you to basically analyze a specific investment idea. He says in there, the long-term return of an equity is going to approximate its return on equity. So if you buy a company that can only earn 6, 7, 8% on equity, even if you buy that stock cheaply, if you hold it for the long term, you're not going to do differently than 6, 7, 8%. On the other hand, if you buy a company that's got a 25% return on equity. Johnson & Johnson's return on equity for the last 20 years has been 22%, okay? You buy this company, or a company like this, with a high return on equity that can maintain it, not through leverage, but through revenue growth and through margin preservation. If you buy a company with a 20% return on equity, even if you paid up for it, you hold it for the long term, you're not going to do very differently from 20%. With that, Fabian, I want to thank you for being together once again, and I look forward to many more of our great experiences and adventures together.
Thank you, David. Thank you very much. We'll be back tomorrow.